Most new traders watch their capital disappear because they enter the market with no plan for the descent. They jump into these trades without a safety net, assuming the market will just naturally push them up. Survival depends on building a mathematical parachute. By calculating your risk before you buy, you can maintain long-term profitability, even if you only guess the direction of the market correctly half the time. To follow along and build your own strategy right now, grab 3 things: your total trading account balance, a target stock you've already analyzed, and a basic calculator. This formula turns a trade into a managed operation by predefining the end state before any money moves. It provides the logic needed to manage a portfolio with the precision of a professional. First, look at your chosen stock and pinpoint your exact entry price. For our example, let's assume your technical analysis tells you to buy in at 350 rupees. Next, identify your stop loss. This is the exact price where your initial analysis is proven wrong, and you must exit to protect your capital. Let's set ours at 348 rupees. This chart shows our entry at 350 and our stop loss down at 348. If we subtract the stop loss from the entry price, we find our risk per share, a difference of exactly 2 rupees. Now we apply the standard for professional trade setups, a minimum 1 to 2 risk to reward ratio. For every unit of risk you take on, the trade must have the potential to return at least twice that amount in profit. Since we are risking 2 rupees per share on the downside, we multiply that by 2. This defines a mandatory minimum reward of 4 rupees on the upside. We take that 4 rupee required reward and add it to our original 350 rupee entry price. This results in a strict target price of 354 rupees. Revisit your technical analysis. If the indicators do not support the stock reaching 354 rupees today, the trade fails the criteria. Do not enter. The rigidity of this 1 to 2 ratio allows a portfolio to survive a string of losses. Let's look at the math across 10 theoretical trades. Even with a coin flip win rate, results stay positive. You lose 5 trades at 2 rupees, totaling a 10 rupee loss. You win 5 trades at 4 rupees, gaining 20 rupees. Subtracting losses leaves a 10 rupee profit. The math forces growth. Relying on this ratio removes the pressure to be perfectly right about every market move. Profitability becomes a function of the system rather than a lucky guess. Even with a profitable system, risking too much capital on a single idea can result in total account failure. You must limit how much of your portfolio is exposed to a single event. Institutional standards cap the maximum risk on any single trade to 2. This gives us exactly 2,000 rupees, your absolute risk budget, and the maximum you can lose if the trade hits your stop loss. Traders with accounts under 1 lakh can adjust this limit up to 3% per trade to ensure they have enough capital to participate in meaningful moves. We then use position sizing to determine the exact number of shares this budget allows us to buy. Divide your maximum capital risk by your risk per share. We take the 2,000 rupee risk budget and divide it by the 2 rupee risk per share. The calculation tells us to buy exactly 1,000 shares. The financial boundaries are now set. If those shares hit your stop loss, you lose exactly 2,000 rupees. If they hit your target, you gain exactly 4,000 rupees. Position sizing provides emotional stability because the best and worst case outcomes are known and accepted before the buy button is ever pressed. This is a professional trade plan, buying 1,000 shares at 350 with a hard stop loss at 348 and a firm target of 354. However, the strategy only works if the exit is enforced. Many traders watch a stock drop and manually move their stop loss out of hope for a bounce. Ignoring a stop loss is what wipes out an account. High-performance trading requires moving quickly on losses to preserve capital while giving profitable trends the time they need to reach the target. Before risking real capital, execute 50 consecutive simulated paper trades. This provides the data needed to prove the math works in live market conditions. Success in the market comes from managing present risk, not predicting the future. Once your paper trading results reflect this consistency, use the links in the description to open a DMAT account and begin your execution.